Welcome, Patrick Jankowski.
Thank you very much, Paul. Thank you, Gil. Thank you, everybody, for Gil for inviting me, and everybody for showing up and tuning into the presentation. I'm going to share some slides on the economy. Afterwards, I am going to send a PDF of the slides to Ashley Byers, and then she's going to be going ahead and she's going to be sharing those with everyone else. I've got a lot of information to cover. What I'm hoping to do is provide you with some insights as to what's going on in the economy and that you can use in your business and help, or at least help you feel a little bit, maybe a bit more comfortable about where we're headed with the economy. So at this point, I'm going to share my screen. Paul, are you seeing my first slide? Okay, then I'm going to go ahead and get started. Maybe you guys, you've ever heard that expression, drinking from a fire hose? You know, where things are just coming at you so fast, it's kind of hard to absorb it all. Well, that's going to be a little bit about what my presentation is going to be like today. It's going to be a little bit like drinking through the fire hose, because I've got so much information that I felt I needed to share with you so you understand what's going on in the region's economy. Now, I'm going to be using the word Houston a lot, and whenever I refer to Houston, I'm referring to the metro area. And no point in this data am I going to show you data which is just the city of Houston. Everything refers to the metro area, and that's going to be the 9-county metro area, which is Harris, it's Austin, Brazoria, Chambers, Fort Bend, Galveston, Harris, Liberty, Montgomery, and Waller counties. So let's go ahead and start that drinking the fire hose. Maybe you guys have seen some of the headlines lately. This is one that was in Forbes just real recently. The recession was over last year. Actually, it was a very short recession, but it was a very deep recession. But the economy is not fully recovered. And if you had to tune out from my presentation right now, you probably got the most important part of the presentation. You know, the recession's over, but we're still recovering. U.S. has recovered quicker than Houston has. Houston is somewhat trailing, and I'll show you some slides that explain why that is. So what happened March and April of 2020? Well, the region lost 361,000 jobs, 361,400. Absolutely incredible job loss. If you want to know how that compares, if you go to the 80s oil bust, that's when I first began my career. I began my career in March of 81 here in the metro area. And we thought that was an absolutely horrible recession. We lost 226,000 jobs. If you go to the Great Recession, which was just 11, 12 years ago, it's the one that's probably freshest in most people's minds other than the COVID recession, we lost 120,000. So you can see that the COVID recession, which only lasted 2 months, compared to multiple years for the oil bust and about 13 months for the Great Recession, was worse than those two recessions. Actually, the COVID recession was worse than the two previous worst recessions combined. You know, you add oil bust and you add Great Recession together, and you still don't come up to the total number of jobs that we lost during the COVID recession. We lost jobs in every sector. Not a single sector was immune from the job losses that occurred in March and April of 20. Food and drinking places, that's another term for restaurants and bars, lost the most. Let's just round it up. That's 100,000 jobs. Retail trade lost 40,000. Healthcare and social assistance lost close to 38,000. Need to understand what that social assistance is a large part of that, because social assistance is the category in which daycares are classified. And so the healthcare did lose some, but the losses are greater in social assistance because it applied to the daycares. Other services, that would be beauty salons, nail salons, barber shops, dry cleaners and so forth, lost 30,000. Administrative support, that's where contract workers would be classified. When the economy's in recession, you let your contract workers go. You don't need to have them showing up to the office. But you can see just about every sector lost jobs. Some didn't lose quite as many. You can see what happened with finance and insurance and transportation, but some lost a lot. So the good thing is people are hiring. I mean, you can't pick up a newspaper. I mean, you can't go out to eat without seeing that there's probably a sign in the window of the restaurant that says we're hiring. Or you can't walk down some shopping center without seeing half a dozen signs in different store windows saying we're hiring. There's definitely a need for workers out there. We're definitely hiring. The issue is the shortage of workers. But to give you some idea of how well we've done, the region has recouped 221,500 jobs. That's like 222,000 jobs since the pandemic ended. And remember, we lost 361. We recouped 221. And through the first 8 months of this year, or through August, we've added 56,000 jobs. Actually, that's really pretty good because in a normal year, this region would add 60 to 70,000 jobs. So in the first 8 months of the year, we've added just about what we'd add in a normal year. Still have 4 months to go. Actually, some of the best months for hiring traditionally are September and October, especially October. So we should see if we just finish up the year the way we finish up most years, we should add at least another 30,000 jobs. I can easily see us finishing up the year with a net gain of 85,000 jobs for the year. It'll still leave us far short of where we were prior to the pandemic, but we made good progress. Give you some idea, economists, boy, we love charts, we love diagrams. Gives you some idea where we are. You can see jobs left to recoup. We've gotten about 39% left to recoup. We've got, that's that 139,000, let's call it just 140 rounded up. And if you look at we've recovered roughly 61%, we've recouped. So we've made progress, but you can still see that there's a huge purple pie slice on the left-hand side. Shows you how many jobs we still have left to recoup, roughly 140,000. Remember I said that in a good year, Houston creates 60 to 70,000 jobs. So at this point in time, we have really the equivalent to about 2 years job growth left that we need to recoup. Doesn't mean that it's going to take 2 years to get them all back. It may take 2 years to get them all back, it may, but it gives you some idea of the gap that we're remaining is the gap equivalent to 2 years of normal growth. So where are the losses? This is on a percentage basis, or what percentage of jobs have been recouped since we opened up the economy back in May of 2020. And you're looking at that and you're probably saying, how can you have 451% still left to be recouped, or over 200%? Now, any place you see a percentage which is greater than 100, that's a sign those sectors continued to lose jobs even after the economy reopened. The government sector, that's a little confusing because in the government in this region, 2/3 of all government employees in the region work for a school district or a community college or a state-funded university. And right now we're in that period of July and August. We have the July and August numbers where we always see a drop off in employment, those two numbers, because students and educators just aren't on campus. And we'll start to see that number shrink and get well below where it is now. But you can see, other sectors, manufacturing, energy, construction, real estate equipment and rentals, and the focus on that is the rental equipment is still struggling. But go on down and let me move to the next slide. And you can look at these sectors here. They're well on their way to recovery. These are almost full, they have either fully recovered or almost there. Educational services, that's private education, and it's tutoring services, and that's driving schools fall within that. We're starting to see a pickup on that. That started in August. A lot of the private schools started back sooner than the public schools did. Arts, entertainment, and recreation, people are feeling more comfortable going to the movies or going to the ballet or going to the gym, and that would fall within that. Other services, the beauty shops and barber shops have opened back up. Administrative support, you're seeing people are bringing some contract workers back on. But you can look at that, these sectors here, probably a good way to categorize these are the sectors which were most impacted by social distancing and by mask wearing and by the shutdown we had in the early stages of the pandemic. And so you would think as we're getting more comfortable with going back to the malls and back to the restaurants, these sectors would recover early. And you can look and see food services and drinking places, we're almost there. If you can look at retail trade, we're almost there. But let me jump, and you can look at, this is looking at it a different way rather than percentage of jobs recouped, how many jobs have left are still short. Now, where are we now compared to where we were in February 2020? And that's when the previous peak was, February 2020. And you can look at the government sector, as I said, that's going to go away pretty soon. Construction, manufacturing, energy, a lot of those are significant to the point where if you look at it here, you can see these four sectors, construction, manufacturing, energy, and wholesale trade, are the sectors that are really struggling the most. Construction, because we're horribly overbuilt. Yes, there's a housing boom going on, and you hear stories from the home building side that they can't find enough workers or they can't find enough supplies. But what the problem is, we've had a significant drop off in office space because we're overbuilt in the office market. We continue to have what's referred to as negative absorption, meaning more space being thrown back on the market than is being leased. And that's affected the construction industry. Manufacturing is very heavily tied to oil and gas in this town. We supply the pipes, the valves, the flanges, the oil rigs. That's struggling because energy is struggling, and energy is struggling because of the transition to new technologies, new ways of providing energy, and the fact that the industry's gotten very efficient at finding oil and gas. And then wholesale trade actually feeds into both energy and to manufacturing. Wholesalers will sell things to the manufacturers who repackage them or put them in sort of their equipment and then sell them to the energy industry. Or some wholesalers sell directly to the oil and gas firms. The problem is those four sectors, they started to decline prior to COVID. So the challenges that those sectors are facing aren't necessarily related to the Delta variant and people social distancing. Construction, as I said earlier, it's because of the overbuilding. You can see manufacturing tied to energy. Energy, its employment peaked in February, peaked a year before the COVID pandemic hit. And so what you're looking at is this isn't a cyclical event, but this is a structural event which is going on with these four sectors. Now, this is another way to look at that pie chart. I told you that we had roughly 139,000 jobs, 140,000 jobs that we still needed to recoup, roughly. And you can look and see over half the jobs we have left to recoup are in the manufacturing, construction, energy, on wholesale trade segment. Now, those are the four sectors which are holding back Houston's recovery. All these other sectors, we will probably get those jobs back within the next 6 months to a year. But a year from now, we'll still be below where we were in employment in these four sectors on the left. If we took those four sectors out and we looked at just the sectors that were impacted by the pandemic, you'd see that we've made significant progress. We've gotten almost 76% back of what was impacted by the pandemic. And so what was good for Houston in the past, the oil and gas industry and the manufacturing associated with it, is actually what's weighing down our recovery. One good thing, though, to look at this is you can look at, there's unemployment benefits. And there are two ways to look at this. One is just what's happening with the searches on Google. I mean, you can actually go and look and with, excuse me, I jumped one too far ahead. And you can actually find out how often a search term is being used in Google. And what I did is I went and looked how often is the term unemployment benefits being searched on Google across the US and in Houston. And you look and see, you can go back to, in the early stages of the pandemic, back in May of 2020, there were a lot more people searching for unemployment benefits percentage basis than there were in the rest of the US. And you can follow that green line, and that green line shows that there are more and more people were needing to file for benefits, looking for benefits than there were in the rest of the US. But you go down to that far end, to the very far right-hand side, and you can see the red line and the green lines are pretty much overlapping and matching. So it's kind of suggesting that we're seeing the level of unemployment benefits in Houston on a general basis falling down, or the layoffs or the inquiries falling down to about the same level they are across the US. So we're not leading the US in this category. We're pretty much tracking the US in this category. And another way to look at this, just look at these initial claims for unemployment benefits that are being filed. And you can see that here, and you can see where we were early in the pandemic, how it's gradually trended down. And the last time I looked at the data, we had filed, in that week, we filed about 4,100 claims for unemployment benefits. These are initial claims for unemployment benefits. Prior to the pandemic, the region would see maybe between 3,500 and 4,000 claims filed for unemployment benefits. So we're almost there, not quite back to the level we were pre-pandemic, but we're pretty darn close. And that's another sign of the healing that's going on in Houston's economy. Another sign that we're getting back to normal, whatever the new normal will be. But it's definitely a sign that you can see the downward slope, and we're almost back to where we're seeing almost no layoffs or very few layoffs, and that helps with job growth and net job gains. So the real question is, how does Houston compare? How do we compare to the rest of the nation? How do we compare to other metropolitan areas in our recovery? Are we recovering faster or slower than the rest of the nation? I remember, back in 2010, 2011, we were just tickled pink because Houston was growing so fast. After the Great Recession, Houston recovered more jobs and got back to its pre-recession levels faster than any other metropolitan area. We led the way. And one of the reasons why we led the way was because of fracking. It's because something was known as the Eagle Ford Shale. Unfortunately, that's not the case anymore. If you just look at it based on unemployment rates, our unemployment rates are higher than the rest of the state and higher than Texas. These are unemployment rates for August. If you look at pie charts, once again, when we talk about the absolute on the left, and you can see where we are, the US has recovered about 76% of its jobs versus that 61% I talked about for Houston. But if we take out oil and gas and construction and manufacturing, we're pretty much on track with the rest of the recovery, rest of the US. Now, the COVID impacted sectors, we're following the rest of the US. It's oil and gas, which is hurting us, and construction. Another way to look at this is what percent of jobs have we recovered compared to the rest of the US. And you can see it here in this chart. And this is the 20 most populous metropolitan areas. New York being the most populous, and Chicago and LA and so forth. I hate to say this, you look to the far left and you can see Dallas is almost all the way recovered. They're almost all the way there. Being a native Houstonian, being someone who's very proud of where he grew up. I always hate to see when Dallas beats it in anything, but this is one time when I guess I have to admit it. Dallas is doing better than Houston. It's kind of sad if you think about this. Out of the 20 metropolitan areas, Houston actually ranks 16th out of 20 in pace of recovery. And the only metros that are doing worse than us are places like New York, which had the horrible impact early in the pandemic. And people are still very nervous about going out in public or going to the office or going in large public crowds. In places like San Diego, Los Angeles, and San Francisco, which are still allowing their employees to work remotely. And that has such a knock-on impact on the rest of the economy because those employees aren't going to the dry cleaners, they're not going to the restaurants, they're not going to the retailers and so forth. So we're not doing as well as the rest of the US in the recovery. But once again, if I take out oil and gas and I take out construction, I take out manufacturing, you can look there and you can see where we are. We actually do a lot better than most of the metropolitan areas. And once again, I'm driving back home the point. Right now, it's the oil and gas industry and construction which are holding back the recovery. So that's kind of it for how does Houston compare to the rest of the US and how we've done in our recovery to date. Excuse me, I need one sip of water. And I want to go through some individual indicators and show you what some of these individual indicators or gauges are telling us about the economy. All right, let's look at the Houston Purchasing Managers Index. For those of you who've seen me present before, this is one of my favorite indicators. It's a survey of purchasing managers done by the Institute for Supply Management. They go out and they talk to the purchasing managers on a monthly basis and ask them a series of questions about employment and backlogs and prices and inventory and so forth, and crunch all these numbers, and they come up with an index. And whenever that index is above 50, that's a sign that the overall economy is expanding. Now, it can drop below 50 and you can still see some expansion in the services sector, but when it drops below 45, that's a sign the entire economy is contracting. And it fits real nicely with what we know happens historically. If you look over here, 0809, that's the PMI talking about the Great Recession. If you look here at 15 and 16, that's the PMI signaling what's going on with the fracking bust. This little dip here between 17 and 18, that's the impact of Hurricane Harvey showing up in the Purchasing Managers Index. And then here you go, there's COVID. Remember I told you it was a very short recession, only 2 months, 3 months versus 3 or 4 months versus the PMI, but you can look and see how far it fell. And then you can look here and you can see it's above 50 and well above 50. So the PMI is signaling that Houston's economy is expanding, and it will expand at least for the next 3 to 4 months. It doesn't mean that it won't expand beyond that. This indicator is only good looking out 3 or 4 months, but it does show that we're seeing healthy signs of growth in the economy. They break down a lot of different metrics in there. I'm going to highlight a few of them. Remember, 50 is the break-even point, if you want to look at it in those terms, and you can see how The break-even point for employment is well above 50, so we should be seeing some employment growth coming along. If you want to look at prices paid, this is a little bit worrisome. This is one of those inflation indicators. You can see it's above 50, and that's a sign that the firms that respond to the PMI, they're having to pay higher prices now than they were the month before that. If you want to go look at lead times, in a normal economy, seeing a lead time where the index is above 50 is a good sign, because that would show that they're building a backlog and they have more orders on the books than they can get out the door, and so it's healthy. If you go and look at the individual comments, lead times isn't doing well here. Lead times is because they're not getting enough components in the shop. They're not getting enough stuff to meet the orders. Lead times are not stretched out because they have too many orders on the books. Lead times are stretched out because they can't get the supplies they need to meet all the customers' orders. And this is finished goods inventory. This is actually below 50. This is counterintuitive. It's a good sign because it means their inventory is shrinking compared to the previous month, which means they're not building up inventory. Their inventories are shrinking because they're meeting their customer orders. So overall, when you look at the PMI, almost every inventory in the PMI looks good except for maybe the prices paid and the lead times. Let me jump over and talk about container traffic. We have 4 ports in the region, 4 wonderful ports. There's a Port of Houston, there's a Port of Galveston, there's a Port of Texas City, there's a Freeport, Port of Freeport. There's an airport up near you guys in the Woodlands, and there's an airport on the way to Galveston called Houston Hobby. And they all handle cargo, but what I really wanted to focus on is what's going out in the containers that gets put on the ships that go out to the Port of Houston. The Port of Houston is the busiest container port on the Gulf Coast. We are seeing some pickup of some containers, some smaller ships coming in that should have been going into the West Coast. But this is an idea of the guys and gals who run manufacturing operations in Houston, and they need containers to put their stuff in and ship them out. What are we seeing? You can look there and you can see loaded imports are up significantly. I'm putting 2019 versus 2021. And that's a sign that everyone's still trying to replenish their inventories. We're trying to get stuff back into the warehouses. We're trying to get stuff back on the store shelves. But loaded exports is down. And loaded exports down, it suggests that we're not exporting quite as much. And as far as the number of containers that are going out, it's not. But if you shift and you look at the dollar value, what's being put in those containers, but the dollar value imports is up, and exports, it's almost back to normal. So think about it. The number of containers have dropped off by almost 120,000 containers. This is through August, but you're seeing only about a $500 million drop off in the value of exports. Part of that is we are seeing what the shippers are doing is they're packing the containers a lot tighter, and we're seeing more higher value goods going out to the containers. And if you talk to them anecdotally, they could be shipping more. It is getting harder and harder to find empty shipping containers. The manufacturers in Asia are so desperate, they're paying to have empty containers shipped back to them so they can fill them up. And I do a lot of reading on this, and the different numbers I've heard is that the cost of shipping, you can make 4 times as much shipping an empty container from the US to Asia as you can bring a full container from Asia back to here. It's because they're just trying so hard to get those containers over there to fill them up and ship them back. So let me shift on over to passenger traffic, and you can see that here. This is passenger traffic in the airport system. It says July. I'm sorry, I updated this yesterday and I forgot to put August on that. This is actually airport passenger traffic through August. And you can see we should have handled about 40 million passengers through August of this year. Only handled about 28 million, but it's a lot better than we were last year. So you can definitely see that passenger traffic to the Houston airport system is up. It's a sign we're seeing mainly, and what we're seeing there is mainly traffic, the leisure and the hospitality site traffic and tourism. We're not seeing that much business traffic. What we're also seeing is a great deal of domestic traffic. We haven't seen a return in the international traffic because of the suspension of allowing foreigners into our country because of the COVID. Hopefully that'll start to pick up some. But you can definitely see that we're up from where we were this time last year. So we are seeing a recovery, not back to pre-pandemic levels, but we're definitely seeing the recovery. And let's talk about construction. Excuse me, I'm gonna have another sip of Ozarka. If you shift to the right-hand side and just look at residential first, definitely residential construction's up because of that housing boom that we hear about. But if you shift to the left-hand side, that non-residential, the office buildings and the industrial parks, that's definitely down. And it has a big impact on employment. For one thing, a lot of residential is done through subcontractors, or a builder will come in and contract out with 2 or 3 guys who do the wiring or the plumbing, or a small company to do the framing, while the office buildings and the industrial parks are done with the big construction firms. If you get a job to work on a site building an office tower, you probably be employed at that site for 3 years. If you get a job building a house, depending upon how many you're building in the subdivision, you may only be there a few weeks. And so, yes, it's a job, but it isn't as long or lasting job as a job that you might find working in an office, putting up an office building or a warehouse or a retail space. Let's shift to what we see happening with the apartment market. The apartment market has just taken off. There's a general rule of thumb in the industry, and that's at 90%. When you get below 90%, the tenants have the pricing power. It's more tenant-friendly market. You get above 90%, and it's more landlord-friendly market. And you can look and see that we were below 90% for a really long time, for over 2 years. And it started to pick up. These blue bar, this black line that you see there. And as occupancy picks up, prices have picked up. And we're seeing in some places where rents have gone up year over year as much as $200 on a prime Class A apartment. We've actually, if you look at the data, the last time I looked at it on a 12-month basis for the 12 months ending in August, I don't have the September data yet, we absorbed about 35,000 apartment units. In a normal year, a good year, we might only absorb 12 or 13,000. And so this has been great for the apartments that are finally able to lease up some of these empty units and collect rents, although they still have an issue with non-payment of rent for some of these. The question is, why is the apartment market doing so well? Well, for one thing, you do have people who are still in apartments who probably should have been evicted, so you're not getting that turnover there. The other is you're getting people who are moving to Houston, to the region, which is a good sign, and they're taking some of these apartments. They're moving from the high cost areas on the East Coast and the West Coast. That's helping. You're also getting people who had renters or tenants who had roommates during the pandemic and have been around them so long, they're just tired of them and they're ready to have their own apartment. And so you might have one apartment with 2 guys in it, or 3 guys who they're all moving out on their own and getting their own apartment. Or you're getting those who had 2 guys who could get along real well and were together in an apartment, but they both need places to work from remotely. So they're both moving out from a 2-bedroom apartment to 2 separate 2-bedroom apartments, so they can have a 1 bedroom for an office and the other bedroom for living or for sleeping in. So it's all those sort of factors that have really helped the apartment market. So the apartment market and the housing market are probably 2 of the healthiest parts of the economy right now. And you can see that we're happy with home sales in the region, on pace to do over 130,000 home sales this year. You do see this little dip right there. That's the initial effect of Hurricane Harvey. You got all sorts of factors driving this: low interest rates. There's a fear of missing out. There's people moving here from higher cost areas. You've got families that saved money up during the pandemic because they didn't go on vacation. They didn't spend anything. You've got families that have recognized that they're going to need an extra bedroom just to have that for an office. All those sort of things are playing into this. But when you talk to the developers out there, they are starting to say they're getting some pushback from the home buyers, potential home buyers, because prices have gone up so fast and are so high now. If you look at it, I probably should have left the chart in. I took it out. If you look at a single family home sold in Houston through the Houston Association of Realtors between 2017 and 2021, August to August, you've seen the value, that the price of that home go from about 280,000 or 89,000 to 379,000. You've seen, well, that sounds confusing without a chart. Let me just put it simply. In the last 4 years, we've seen the price of a single family home sold through the Houston Association of Realtors go up $90,000, almost 30%. So let me shift on to the next slide. And this is auto sales. And we could be selling a lot more automobiles in the region if we had them. Now, this is a 12-month moving average, and you can see the peak coming out of the fracking boom, the fracking bust. This is when everything shut down briefly for Hurricane Harvey. And here we see the slide that occurred during the pandemic, and now we start to see people willing to buy, but they're starting to plateau, and the plateauing is just because of lack of inventory. So on one hand, you could take it as a sign of consumer confidence that consumers out there want to, they're willing to go out and buy cars and buy trucks. There's just not much inventory out there. And the inventory, as you've heard, is because of the chips. And this situation will probably be like this. The general, as I talked, just got back from a conference in Washington, D.C., where I talked to a lot of my fellow economists, and I talked to people at Ford and GM, and I talked to people at some of the chemical companies and the oil and gas firms and the manufacturers. And they're all thinking the supply chain issues will probably take at least another 12 months to get resolved, which is also kind of suggesting is so much of what we're seeing with inflation is tied to these supply chain issues. We'll probably have some inflation with this for probably another 12 months. So let me shift. I want to go into a little bit more detail about oil and gas since it's so important to the region. And I've been talking to you about how oil and gas is one of the big factors which is holding back the recovery. So we've seen a nice run up in oil prices since the bottom of the pandemic. You can see in April, oil prices only averaged about $16, $17 a barrel. We had that one day when oil prices were negative. That was an issue with contracts, and someone couldn't find anybody to take the oil off their hands. But as demand started to go up, you started to see prices go up. And since the first of the year, we've seen crude at $52 a barrel or better. And what's interesting about that is in the southern part of the U.S., in places like the Permian or the Eagle Ford, most oil and gas firms, they can make a profit at oil at $50 a barrel. And you can see that we've had oil go from around $50 a barrel up to 72. I didn't look at it this morning to find out where it is right now. But we've had oil prices in that area where you would think we would see a pickup in drilling activity because it's in the range in which oil and gas companies can make a profit. But if you look at that, the rig count has not picked up. And you can see where we were at the height of the fracking boom, the fracking bust. And I told you the oil and gas industry's woes started prior to the pandemic. And you can see here, the early part of 2019, the slow downward trend in the rig count. And then the pandemic hit, and you see the drop. And we've got this gradual pickup, but we're still have less than half the rigs we had working prior to the pandemic. And that's one of those things, gosh, you think supply and demand, the price signals, oil is in the range in which an oil and gas company can make a profit. Why aren't they out there drilling more wells? Well, there are 4 reasons why they aren't drilling more wells. One is this concept of capital discipline. The Wall Street has loaned so much money to the oil and gas industry and been so disappointed on the returns that it's gotten from the industry that the capital markets have shut down. The bankers have scaled back on how much the companies can have in their line of credit. Private equity markets are closed. Bondholders don't want to buy their bonds. And so they're enforcing on them something called capital discipline. For so long, the industry focused on growing production at the expense of profits. And investors have said, no, we want you to grow profits and not production. And they're forcing them to drill their wells out of cash flow, funded out of cash flow. And so that's the reason why they can't go and borrow money to drill wells to make them to tap into these higher oil prices. They've also been using the cash flow that they have to pay down and clean up their balance sheets. And they've been doing this. This capital discipline started back in 2018. It didn't start now. And they're trying to clean up their balance sheets. And they are cleaning it. And the good thing is, a year from now, all the oil and gas firms should have a lot cleaner balance sheets and be well positioned if we need to ramp up drilling in a year or two from now, which I think we probably will. The other issue is they've done something called they hedge their production. And it's kind of like hedging your bet. And what they did is and it's very common in the industry, they found companies, they signed contracts with them, and the contract stipulates that the oil firm will deliver X number of barrels at a fixed price. And what we saw is about half of the U.S. production was hedged at around $50 a barrel, meaning the oil companies promised that they would sell their crude at $50 a barrel to refiners or traders and so forth. And that made a lot of sense because when they signed those contracts, oil was trading at around $45 a barrel. So let's lock it in at 50. We don't think prices are going to go much higher than that. But then when oil prices got up to $70 a barrel, they're still obligated to sell it at 50. So they didn't get the benefit of that increase in prices from 50 to 70. They got some of it from what wasn't hedged, but they didn't get the full benefit. You also have pressure from shareholders. Now think about it, Exxon now has lost three slots on its board to somewhat dissident shareholders, which are pressuring the industry, pressuring Exxon to diversify away from purely oil and gas and get into more into these alternative energy sources. You see it at Chevron, you see it at Shell, you see it at BP. And so some of the capital that they would have, they might normally deploy back into oil and gas drilling. They're putting into solar and they're putting into wind, or they're putting into carbon capture use and sequestration and all these other alternative sources. And so that's one reason why you're not seeing the rig count go up. You know, if the rig count goes up, we have more people working the oil field. The rig count goes up, we have more need for oil field equipment. The rig count goes up, we have more people in Houston supervising what's going on the field. And then there's finally this thing called a DUC. DUC actually stands for something called the drilled and uncompleted well. You know, a lot of oil and gas firms that were drilling wells, they finished the well, they finished drilling, they knew how much oil was down there, and they said, okay, we're going to kind of seal this well off, we're going to cap it, and we're going to come back to it when we need it. Because it's more expensive to complete the well and bring on production than it is to actually drill it. And so what you saw during the downturn, during the weakness, is a lot of them going and completing their DUCs and maintaining their production by completing wells that had already drilled. They knew where the well was. They knew exactly how much oil and gas was down there. All they need to do is lay some, do some fracking and lay some casing and bring them on. And that's what you can see. And so the good sign is the number of DUCs is on its way down, almost down to pre-pandemic levels. There always a certain level of DUCs. When the industry has gotten down to a normal level of drilled but uncompleted wells, a normal level of inventory, they are going to have to start drilling new wells again. And depending upon which analyst you look at, they'll either exhaust all their DUCs by the end of this year, or they'll exhaust them sometime in the first quarter of next year. So that bodes well. If demand remains at a normal level and supply continues to dwindle from some of the existing wells, we'll need to start seeing more drilling activity in the U.S., and that bodes well for the oil and gas industry. It's not going to get us back the 40,000 some odd jobs that we're missing in the industry, but it'll help get some of them back. But this is probably, I don't know, I joke, I sometimes say this is perhaps the scariest graph I'll show you. The oil and gas industry is not what it was 7 years ago, and it probably never will be. This is the path that industry employment has taken in Houston going back over the last 21, 22 years. This is exploration production jobs, oil field service jobs, equipment manufacturing jobs, pipes, valves, and flanges, engineering. And you can see how they peaked. They actually peaked in December of 2014, and that was a fracking bust. We saw a little bit of a recovery, but then we started seeing capital discipline. We're not lending you any more money. You have to fund it out of cash flow. And then you saw COVID, and that brought it down like that. And we've just been kind of bouncing along. And think about this. We've lost roughly 100,000 oil and gas jobs since December 2014. And most of those jobs are never coming back. So it kind of suggests we need to look into other areas to find growth in the region. And there are other areas. We are going to get growth from the sectors that are the non-traditional, the energy transition sectors, the solar and the wind, and the carbon capture use and sequestration, and more efficient use of electricity distribution and so forth. But it'll take a while to recoup, to ever get back. We'll never get back in traditional oil and gas where we were there, but we might get back there with some of the other sources. So I want to shift, and I want to make a fairly dramatic shift. I do want to talk a little bit about population, because everyone needs to know what's going on in population, and I'll finish up with just a few COVID slides. For those of you who want to know, I'm about 80% through my presentation. So we've seen some wonderful gains in population in the region over the last 50 years. If you look at the decade we just completed, that's 1.2 million jobs. Just a little bit weaker than the decade before, but you can look and see the last 30 years, we've added close to 2.4 million in population. Where do we rank in that over the last decade? We actually ranked third in total number of population that we added. We added this, there's the 1.2. These are those same 20 metros I showed you earlier about where we ranked in jobs recouped. Unfortunately, Dallas did add a few more people than we did, and then there's New York and Atlanta and so forth. Where did the job growth come from? Harris County accounted for roughly half of the growth in the region, followed by Fort Bend and Montgomery County. Montgomery County added almost 165,000 people over the last 10 years. But you can see every county added some. Austin didn't add many, but it did add some. The two big drivers of growth are Harris County, Fort Bend County, and Montgomery County. But what you need to understand, there are two things you need to know about the growth that we had over the last decade. And once again, this is for the metro area. Over 60% of that growth occurred in the first half of the decade. Think about it, we had the fracking boom and we were creating jobs at the rate of 100,000 a year. People were moving here for jobs because there weren't jobs in Detroit or Chicago or New York or Atlanta. They were moving here, and that was the big draw with jobs. But once the economy started to improve across the rest of the US, about the middle part of the decade, we weren't drawing as many people into the region as possible. And then we had some issues with our own fracking bust, which suppressed some of the growth in the latter part of the decade. And the other thing that you need to understand is, yes, we added 1.2 million people, but a significant number of that came through births, just came through more babies being born than people passing away. It's referred to the net natural increase. Now, we always will be adding population based on the fact that we're going to be having more people being born than people dying, but not necessarily through migration. And if you look at the two factors of migration, international and domestic, over the last decade, we added more people moved here from overseas. They moved here from elsewhere in the US. And this considers all migration. This could be expat workers who were brought back by oil field companies. It could be people here on work visas, people here on student visas, refugees, and people who are here undocumented in the region. So, it's not 1.2 million people moved to the region. We added 1.2 million people, and roughly half of that was through the net natural increase. What sectors added the most in population? Almost half the population gains came in the Hispanic community, followed by the Black community and the Asian community. I mean, the Asian community had, if you look on a percentage basis, the Asian community grew the fastest, although Hispanic community added the most. It's another chart that I needed to put back in here. The challenge is, I told you the fastest growing communities that added the most in population were the Hispanic and the Black community. But that poses some challenge for us when so much of our future growth is going to be depending upon having a well-educated workforce. And you can look at just the educational attainment, and the sectors that are the fastest growing lags out of the community as a whole. There also have issues that they tend to be in households which don't pay as well, that aren't earning as much. And income is important to be able to go off to college, or at least go off to community college. And we have a high number of families in those communities in poverty. So it shows if we're going to continue to prosper in the region, we have some work to do to try to increase the educational level and increase the earning potential of some of the fastest growing communities. So just 2, 3, 4 slides left. I want to show you just something on COVID, and then I'm almost done. Luckily, we're seeing that this fourth wave of the virus is starting to settle down. This is what we were looking at back in November, December, right as we started to get the vaccination. And then we started seeing through vaccines and through more conscious social distancing, the drop off. And then we saw the Delta variant here. But the good thing is you can see the downward trend here. This is for the US. If you want to look at it just over the last 90 days, it shows this just nice sloping down curve here. So for this version of COVID, hopefully this is the last one that we have a real problem with. There are other versions out there, but the last one that seems to kind of run rampant through the population. It seems to be waning. You see that in the local numbers. This is hospitalizations at the Texas Medical Center. And you can definitely see the number of hospitalizations at the TMC is on the way down. And if you look at the daily case rates, they're down as well. So hopefully we're on the downward slope of this. We're past the worst part of the Delta variant. And that's one other thing that will help with the economic growth in the region. But I want to put it in perspective to get you some idea of just how bad COVID has been for the region. And we've had almost 900,000 people infected with the virus in Houston, Metro Houston. That's like 1 in every 8 residents has come down with some version of the COVID-19 virus. And 11,000 people have died. That's like 1 in every 600 residents in the region has died during the pandemic. And I've put it up there. If you want to look at it just by county, and you can go look and see where it is for Montgomery County and how Montgomery County has compared to the rest of the region. If you look at on a per resident basis, Montgomery County has not done as well. They've had more people get infected on a permanent resident basis than the rest of the region. If you want to look at the death rate, though, the death rate hasn't been quite as bad, and that's probably because of better access to healthcare with some of the hospitals up there. So the worst is over, but it's definitely taken a toll both on the economy and on the community. So with that headline in Bloomberg that I saw yesterday, the COVID recovery is spreading and prospects are improving in 47 states. So the worst is over, and with the worst being over, that shows that we should start to see some signs of growth. Houston is going to be struggling with the oil and gas industry reinventing itself, but the long-term prospects for the region still remain bright. So with that, we all need to keep our fingers crossed that the worst is over, that more people will get vaccinated, that will get the virus under control, and that the economy will pick up speed and grow maybe a little bit faster in 2022 than it did in 2021. With that, thank you very much. I appreciate you taking time to listen to me. I know I probably used a little bit more time than Gil wanted me to, or Paul wanted me to, but I felt I had a lot to. Now I will turn the fire hose off. You guys can stop drinking from the fire hose, and I'll get back and answer some questions. So stop sharing. Thank you very much, everybody.
Patrick, thank you for that. We're going to turn the fire hose in the other direction now and ask you a few questions. It's
Okay.
Interesting because at this point in time, we read both in the US and maybe Europe, we might actually be facing an energy crunch in the next coming months in the winter. Why do you think that we have an oil bust going on? What is going on here?
Well, it's the potential for that, and that is we have not we've not been bringing enough production on, and the general thought is that as demand grows, OPEC will be able to pull more of their production back into the market because they took so much of their production off. They took what, 20 million barrels of production, but we're finding out that OPEC has not been able to, even though they're allotted to bring this much, each nation's allotted to bring 400,000 barrels a day, well, not 400,000, that's the total per month. We're finding out that even if they're given that quota, many of the nations in OPEC are not up to that quota. So there's a question is maybe their production is not able, they're not able to meet that production. The infrastructure isn't there. They haven't been drilling. That's part of it. The other is that in the US, prior to the pandemic, at one time, we were producing close to 13 million barrels a day. And we got down below 11 million, and we're gradually working our way up. The last time I looked at the numbers, it's about 11.3. But we brought down production so much in the US. One of the crises, though, when you talk about that, it's really a natural gas crisis. And that's because we're not drilling the new wells, and so much of the gas that we get comes from drilling the oil wells. And so it's not as much an oil crisis right now as it is a gas crisis that's potentially looming out there. The other thing is, when you talk about the crisis, that's on kind of the production side. The other is we've changed our energy mix, and we've taken so many, especially in Europe, they've taken so many coal plants offline and tried to replace them with natural gas. And in Japan, they've taken almost all their nuclear offline after Fukushima and tried to replace it with gas. So the demand for gas globally has risen, but the ability to supply it has not. And you will probably see, you're going to start seeing countries bringing some of their coal back online just because they have no other choice.
So Patrick, from a regional point of view, we talked about we've lost 100,000 energy jobs probably permanently, and that they hopefully will be replaced with the transition to new energy technologies. But there's sort of a center of or a nexus for the old energy jobs. We have a state legislature that's pretty hostile to new energy. does that leave us running the risk that those new energy jobs won't come to Houston? Maybe they'll end up in Nevada or somewhere else?
When you say hostile, that may be too strong a term. I think it might be better to classify it as skeptical. I think what we have in the legislature is a lot of people are traditionalists. And I think they're having a hard time stepping away from their traditionalism. The issue with the jobs is, for one thing, we have, this will always be the focal point of the world's oil and gas industry. And we will, even 50 years from now, we will still be needing and consuming hydrocarbons. We might not be putting them in our gas tank, but they will go into we'll still need them for plastics, for medicines. I mean, the laptop that I'm using right now has lots of plastics in it. So there'll always be a need for that. So I need to make sure people don't think that oil and gas is going away entirely, but it is a mature industry and it's going to shrink. As far as what's going to happen with those jobs, that is a challenge for us here in Houston, because a lot of it is software-based, digital-based, analytic-based, different sort of materials-based. And we're trying to make sure that when a company in Houston contracts out for work, they offer the grant to the University of Houston or Rice or somewhere here in Houston, and don't go to Stanford or don't go to MIT. And that's a danger. So yes, there's the risk of them going somewhere else, but not because of the hostile legislature. It's just because of we don't have the full facilities here that we should have to develop that. That's one of the reasons why this is digressing, why we had a problem with Amazon. Amazon did not, when they were looking several years ago about locating a second headquarters, they didn't want to consider Houston because we did not have the tech workforce. Now we're working on that, but that's where the risk is. And it gets back to education I talked about earlier. We need to do a better job of educating and growing and organically growing our tech workforce for us to continue to own part of this energy sector.
So how do you see this playing out? Another question here. How do you see this playing out compared to previous oil busts, previous housing booms? In fact, with regard to housing, is this a bubble that might pop?
There's a difference with housing this time than last time. And housing we were building, people were qualifying for loans or receiving loans that didn't qualify for them. The classic expression, the liar loan, where you didn't even have to show proof of income to get the loan. And so that's what created the bubble, and people were buying and speculating. And you're not seeing that now. You have to, very difficult to qualify. It's much more difficult to qualify for a loan now. And you're not seeing these new houses being built for speculators, at least not that I have heard of. It's for families that realize they need an extra bedroom, or it's for people who you're seeing there are all sorts of things come into play. Part of it is millennials are finally buying homes. Part of it is people realize that they want to have green space and park space, so they're moving in the communities that have that. Fewer people, the millennials realize it's not as much fun to go to the bar anymore now that I'm in my mid-30s. Maybe I want to have my own backyard. It's low interest rates. It's all these sort of things which are coming into play. So if it was simply speculation, that would be a bubble. The concern, though, is that prices are getting pretty high, and people who would like to buy a house are being priced out of the market. We're just kind of getting a hint of that now. I think we're going to probably see a really tight housing market for another 6 to 12 months, and then it'll get back down to normal. Because we're just now starting to hear people saying, backing off a little bit. After I've heard that 3 or 4 months, and I say, okay, it's turned, but it's still too soon to see that.
Now, the office market, I understand, is completely different, though. What are the forecasts? I mean, so many of the office that aren't Class A and in really premium locations are really, sucking wind trying to survive. What is the forecast for an improvement in the office market?
Gosh, is that question asked by someone who either leases or owns? My heart goes out to you. There is. I have not been able to figure out how we get out of this office situation because we have so much empty office space. And the last report I looked by NAA Partners, it was another over 1 million square feet of negative absorption last quarter. We have roughly, it depends upon whose data you look at, we have between 60 and 70 million square feet of vacant or available office space. anywhere from 25 to 30% of the market is vacant. I think what you're probably going to see, some of the Class C buildings will eventually get scraped, get torn down to another use. Class A, you'll see people moving from Class B to Class A. But as far as trying to get the rates back up, it's a long way away, guys. It really is, because there's just too much out there. And if my advice to you is do everything you can to hold on to your tenant, because if that tenant moves out, you're going to have a hard time finding another one to take the space. Cut them some sort of sweetheart deal to keep him or her in the space.
Thank you, Patrick. Well, we're almost out of time. Thank you for your time today, and also for everyone for tuning in. The Economic Development Partnership is proud to host events like this throughout the year to keep the community informed. For those who are not members of the Economic Development Partnership and are interested, you can call them at 281-363-8130 and join. We need you. We need your support. This is a member-driven organization. So have a great rest of the week.